Today, stagflation, coming up fast, 1970s, here we come. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, commodity prices are booming from oil, wheat, nickel and gas as the fallout from Ukraine drives momentum which actually was already in play before the recent conflict started. To get a sense of how volatile commodity markets are right now, take a look at this chart from Deutsche Bank's Jim Reid, based on Thomson Reuters Core Commodity Index. Reid points out that it's starting to mirror the energy price shocks of the 1970s. The rolling 3-month move in this overall commodity index was up 35.9%. That's just below the highest ever, which was 41.9% seen in the 3 months to August 1973. That, of course, though, was before the latest gyrations. And surging energy and commodity costs means higher inflation is absolutely inevitable. The Eurozone is particularly dependent on Russian energy and is therefore the most exposed to stagflation risks, though the United States actually isn't immune either. Goldman Sachs analysts estimate a sustained $20 rise in oil prices would erode Eurozone GDP growth by 0.6 percentage points this year. And if Russian natural gas stopped flowing, an additional 2.2 percentage points would be lopped off, they say. That would put paid to most of the economic expansion expected by the European Commission, which in February they forecast at 4% for 2022. So have no doubt, costs of living will spike higher than previously anticipated, and the overhang will be longer. As the BBC reported, the UK Resolution Foundation forecasts that a typical household income will fall by about £1,000 this year, once the effect of inflation is accounted for. That would be the biggest real-term fall in income since the mid-1970s, it added. A government spokesperson said it recognised the pressures households are facing. Many families are already expecting their monthly spend to go up when the energy price cap jumps in April and national insurance contributions rise. But in their new report, the Resolution Foundation says the Ukraine conflict would push up living costs even further as the price of fuel and other goods surged. It expects inflation, which measures how cost of living changes over time, to peak in April at 8.3%. That is much higher than the Bank of England's forecast of 7.25% back in February. The crisis in Ukraine has increased both the scale of price rises but also the degree of uncertainty about their levels and duration, the Foundation's report said. And now consider poor old central banks, which are watching inflation booming thanks to the commodity boom, and they're considering lifting the cash rate. Two questions, though, spring to mind. How will high interest rates help to alleviate the commodity crisis? It won't. And how will higher interest rates alleviate the cost of living pressures? It won't. So we're set for stagflation, which occurs when inflation rises while economic growth slows. The US actually last suffered from this economic malady in the 1970s to the 1980s. At the time, oil prices skyrocketed and the inflation rate reached double digits. Meanwhile, unemployment soared to 10.8% and the S&P 500 lost more than half of its value. Now, history may not repeat, but it sure does rhyme. To an extent, governments can mitigate the shock just as they did during COVID. They can shield the poorest in society from surging food and heating costs by increasing payouts to the unemployed and to low-income households. Finance ministers can reduce taxes on energy and food products or on a range of consumer goods. And they also have the option to defer tax hikes, like, for example, the one that's planned in April in the UK. That said, governments face different challenges this time around. First, high inflation means central banks are, for now, still going to be raising interest rates to tighten financial conditions rather than easing them. And second, the public sector is already burdened with borrowing from COVID-19 measures. General economic debt in advanced economies hit 122.7% of GDP in 2020. That's up nearly a fifth from the previous year and has still only retreated slightly since then, according to IMF figures. But there's also the cost of doing nothing. Lower growth and rising unemployment would mean more people in economic distress and higher welfare outlays, and meanwhile governments would pay a political price in forthcoming elections for high fuel prices if they do nothing, though more borrowing may also be unwelcome. Resisting economic stagflation actually means accepting yet more big government, and that has its own penalties attached to it. Now, so far as the markets are concerned, all three US major stock benchmarks ended lower on Tuesday after a very volatile trading session, with the S&P 500 booking the session's largest percentage drop as investors weighed an American ban on imports of Russian oil and those soaring commodity prices. The Dow Jones Industrial Average, the S&P 500 and the Nasdaq Composite each have fallen for 4 straight days trading, according to the latest figures. The Dow Jones Industrial Average fell 0.6% to close at 32,632. The S&P 500 fell 0.7% to 4,170, and the Nasdaq Composite declined 0.3% to 12,795. Remember that stocks had fallen sharply on Monday, with the S&P 500 logging its biggest daily drop since October the 28th, 2020. The Dow's decline saw the blue chip gauge enter a market correction as the benchmark was 11% lower than its January the 4th record high, while the Nasdaq entered a bear market with the tech-heavy index down more than 20% from its record peak in November. The fact that the Dow is now in correction territory says a lot about how much risk there is in the economy. The index is mainly comprised of mature, economically sensitive or cyclical stocks. Those stocks are more reliant on a strong economy. So when they have a rough stretch, it usually signifies concerns about the big picture outlook. Losses in the year after a closing correction territory tends to happen when markets are anticipating a recession. In late June 2008, the Dow closed in correction territory and went on to lose 26% in the following year because markets were still pricing in the damage brought on by the 2008-9 financial crisis. Now, on Tuesday, President Joe Biden announced a US ban on Russian oil imports, ratcheting up pressure on Moscow in retaliation for its invasion of Ukraine, as the war in Eastern Europe continues to worry investors. Russia's deputy prime minister said the country could cut vital natural gas supplies to Europe and said oil prices could jump to $300 per barrel if the West imposed a ban on Russian oil. The great concern of war on the continent has everyone alarmed, said John Lynch, chief investment officer at Comerica Wealth Management, in a phone interview. Investors worry about the ways Russia's invasion of Ukraine adds to an already high inflation, he said, pointing to the jump in costs of commodities in areas such as metals, agriculture and energy. Oil futures ended higher on Tuesday, with the West Texas Intermediate crude for April rising 3.6% to $123.70 a barrel. That's the highest month contract finish since August the 1st, 2008. Energy has been part of our cyclical play in the stock market, said Lynch. It's getting very expensive, but it looks like there's room to run. Shares of Chevron closed 5.2% higher on Tuesday, while ExxonMobil finished up 0.8%. The surge in oil prices has benefited US energy stocks, noted David Banchin, chief investment officer at the Banchin Group. In fact, of the 11 sectors of the S&P 500, energy is the one in positive territory, soaring up 39% this year. With higher prices, oil producers receive higher profits for their product. Even with the surge in oil prices, there is still additional opportunities in the energy sector stocks, such as midstream areas, which is responsible for transporting and storing oil, he said. The transportation of energy plays a huge future of the US energy story. The gyrations in commodity markets continued on Tuesday, this time in nickel, where on the London Metal Exchange, prices jumped past $100,000 per tonne before they imposed a trading halt. The LME took the rare step of saying it would consider to cancel or adjust trades that were made in a manic period after the official close on Monday, when a violent short squeeze drove prices to a level more than twice their previous record high 15 years ago. Having peaked at $101,365 a tonne, the benchmark contract was trading at $81,051 when it was suspended. The incident is the latest indication of the stress rising in financial markets across the world in the wake of the US and European sanctions on Russia, which were imposed after Russia's invasion of Ukraine at the end of February. As with oil, natural gas and wheat, Russia is one of the biggest sources of nickel in the world, accounting for some 17% of global supply, and any attempt to restrict its exports must have far-reaching consequences for the world market. Nickel is most commonly used in stainless steel, made for the automotive, appliance and construction sectors. However, incremental demand is coming overwhelming from the electric vehicle sector, for whom it is an important battery material. Analysts at Reid Energy expect the spread of electric mobility to raise the global demand for nickel by over 35% to 3.4 million tonnes by 2025, from around 2.5 million tonnes last year. The average Tesla car contains around 45 kilograms of the metal. Growing demand from EV makers had already drained LME inventories last year, and they now stand at their lowest level since 2019. Various reports attributed the surge in prices to the increasing desperation of Chinese participants to cover short positions. China Construction Bank, one of the country's largest state-owned banks, was granted extra time on Monday to meet a margin call that it had missed earlier. The report suggested that the position was ultimately held by Zhejiang Holdings Group, China's largest nickel producer. The Financial Times quoted the company as telling a local Chinese news agency that it had already held a meeting this morning, is sorting out the relevant materials and content, and will make a public response in due course. Zhejiang's website wasn't working at the time of publication, and the surge also badly hit all other brokers holding short positions as hedges for their daily business. The LME said it would calculate margin calls on the basis of Monday's closing price of around $48,000 a tonne. Investors should be prepared for further market volatility and losses from here. It's certainly possible, said Shima Shah, chief strategist at Principal Global Investors. Even as headlines disrupt and distort the underlying picture, the investment trends that are emerging are based on fundamentals and therefore should likely solidify in the coming weeks and months ahead. Shah said that given the chaos, US equities have held up well, particularly relative to Europe. The Stoxx Europe 600 has dropped by around 15% so far in 2022, while the S&P 500, the US large cap benchmark, was down around 12%. Not only is this a reflection of the underlying strength of the US economy, but also America's status as a net energy exporter, she said. By contrast, as a net energy importer dependent on Russian oil and gas, the European economy faces considerably greater downside economic risk. In US economic data on Tuesday, the National Federation of Independent Businesses said its Small Business Optimism Index dropped 1.4 points, 95.7 in February. That's a one-year low. The largest number of small businesses since 1981 said high inflation is their chief worry, with many increasing prices to offset their own rising costs. Small businesses are really challenged, said Luke Tilley, chief economist at Wilmington Trust. They've attributed a lot of that to inflation in their costs of goods and labour, he said. Meanwhile, the US trade deficit climbed 9.4% in January to a record $89.7 billion as the US bought more foreign oil, autos and other goods. The deficit is going to be a drag on first quarter GDP, said Tilley. We're buying a lot more than we're selling abroad. And elsewhere, McDonald's said it would temporarily close its 850 stores in Russia in response to the invasion of Ukraine. And several Russian banks said on Sunday that they would start issuing cards using the Chinese UnionPay card operator system, coupled with Russia's own MIR network, after Visa and MasterCard said they were suspending operations in Russia. Announcements regarding the switch to UnionPay came on Sunday from Sberbank, Russia's biggest lender, as well as Alfa Bank and Tinkoff. And elsewhere, the yield on the 10-year Treasury note jumped 12.2 basis points to 1.87%. That's the highest since February the 25th. And the dollar index, which is a measure of the currency against a basket of 6 major rivals, was down around 0.2%. Gold futures for April delivery rose 2.4% to settle at $2,043 an ounce, and Bitcoin was up 1.7% to 38,518. So uncertainty continues to rule, to the point where the head of markets for JP Morgan Chase said on Tuesday that markets are too treacherous to update the firm's first quarter outlook for trading revenue. The markets are extremely treacherous at the moment, Troy Robban explained at an investor conference. There's a lot of uncertainty. There's a lot of clients that are under extreme stress. That creates potentially very significant counterparty risk exposures. Turbulence stemming from the Russian-Ukraine war and related sanctions from Western nations has spread across commodities, especially, but also through fixed income and equity markets, he said. It is broad-based, but clearly relating to sanctions. Whether it will be sanctioned counterparties, sanctioned products, unwinds, he said. JP Morgan last month said that market revenues would likely be down around 10% from a year earlier, and he said that the outlook had proven true up till last Friday. So we are facing a considerable number of headwinds, and of course the underlying issues, the conflict in Ukraine, are still raging. But the issue of stagflation or depression or market falls, and all of those things are very live, as is the rising costs to households and consumers and small businesses. And this is the angle that we need to focus on ahead, because unfortunately we are also in the front line, insofar that costs are likely to rise significantly while incomes aren't. The squeeze is on. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.